It's easy for the market to veer away from underlying valuations for long periods of time.
Yeah.
I mean, we've seen that, and so you obviously can't trade on that. When you're talking about the variation from the markets and the underlying economy, it can't vary quite as much. You know what I mean? And so I think valuations, I mean, they can be crazy for long periods. But when the economy is really beginning to move in one direction, what happens is that one event happens. I don't know whether it's Brexit, I don't know whether it's the next, NFP or what it is. But something happens and then everyone says, oh my God, what were we thinking?
Yeah.
We just need to re-register. That was crazy, right?
Sure.
But I think
snowball effect.
Yeah, and I just think the underlying behavior of the economy, particularly earnings. I mean, earnings is it. I mean, if your earnings aren't growing,
yeah.
Anyway,
enough
that's how we
feel. I mean, it's something we've called out constantly. It was a big part of our macro themes deck. It's something we'll continue to watch.
And it's also something that we're well educated in, and this is why I've spent so much time. And thank God we've had Neil educate people or start to on demographics as a major factor here, amongst many factors. So you have multiple factors. Demographics obviously is a major factor. Growth, major factor. Fed, major factor. Inflation, major factor. But if you take all those factors and you look at the history of U.S. stocks, I mean, my professor at Yale, Robert Shiller, has written extensively on this. There's this, if you look at it from Shiller's perspective, and you use, again, actually you don't even have to use the cyclically adjusted P. If you use it, it's very, very obvious. If you only use a P, like a trailing P, you'll still see that this is one of the top 3 equity bubbles in world history. That includes don't forget that there was one in 1929, there was one in 1999, and there's this one. There's only 3 times in human history have you had so many debate what so few understand, which is this is one of the top 3 equity market bubbles from a classic valuation perspective, never mind a cyclically adjusted one, basis in world history. I mean, no wonder it drives people crazy. But you know what? You pull back a chart. Go get yourself a chart. I have it. It's right. I'm in my library right now. I'm actually looking at it. The chart goes back to 1880, and that's what Shiller's main contribution to behavioral economics really was. Is that there's this thing in math called mean reversion, and mean reversion happens very, very quickly when you're from these multi-standard deviation breakout points or bubble points in market multiples, and that's a really important thing. The other thing, of course, that Shiller's proven over the years is that stocks move well around the distributable dividends or cash flows that companies pay out. That line is much more stable across over 100 years of history than something like the stock market. The stock market is just one gigantic emotional roller coaster.